Hi, I'm Kurt,
And I'm Dom.
and this is an economics report on the balance of payments vs economic growth. So, what is the balance of payment? The balance of payment, or BOP, records all financial transactions made between consumers, businesses, and the government in one country with others.
Economic growth means an increase in real GDP and means there's an increase in national output and national income.
So, what is it exactly? So the balance of payment figures tell us about how much is being spent by consumers and firms on imported goods and services, and how successful firms have been in exporting to other countries. Inflows of foreign currency are counted as positive entry, e.g. exports sold overseas. Outflows of foreign currency are counted as a negative entry, e.g. imported goods and services. What is the basic structure of the balance of payment account? Is another question. And so the balance of payments is sorted into the current account, which is the balance of trade in goods, balance of trade in services, net primary income. This includes income from interest, profits, dividends generated from foreign investment, and also migrant remittance, i.e. payments from people living over and working overseas. Net secondary income. This includes for the UK our annual contribution to EU, spending military aid overseas, development aid, and moreover. And the capital account is the sale or transfer of payments, copyrights, franchises, leases, and many other things. Then you have the financial account. This includes transactions that result in a change of ownership of financial assets and liabilities between the UK residents and non-residents. Then we have the net balance for foreign direct investment flows, which is called the FDI. Net balance of portfolio flows, e.g. inflows and outflows of debt and equity. Then you have the balancing of banking flows, hot money flowing in or out of banking system. Then you have the balancing item, which corrects estimated errors and omissions.
Back to economic growth, there are three policies to increase economic growth. They are supply side policies. Government attempts to increase productivity and increase efficiency of the economy. Monetary policy, reducing interest rates to stimulate economic activity. And then fiscal policy, higher government spending and or cutting taxes to boost AD. This can have some benefits of higher incomes for workers, increased tax revenue for the government, which can be invested in public services, it can be invested in firms, and also finally it helps create employment. However, this does have some downsides. Inflation, if the economy is growing too quickly, prices could rise quite rapidly. And finally, the current account deficit would increase if the growth is unbalanced.
So now the conflicts. When real incomes are rising at a rapid rate, consumers will tend to buy more imports, leading to a worsening of the trade balance. Secondly, fast-growing countries may suffer from high inflation, which worsens the competitiveness of domestic industries, including exporters. Businesses will need to import extra materials, components, and capital equipment to help expand production. Lastly, a period of fast growth may come into conflict with the trade balance of payments. However, much depends on the income elasticity of demand for traded goods and services.
Okay, now getting back to economic growth, the government could introduce expansionary fiscal policy. This involves increasing AD, therefore the government will increase spending and or cut taxes. Lower taxes will then increase consumer spending because they have more disposable income to spend. This will tend to worsen the government budget deficit and the government will need to increase borrowing. So there'll have to be a trade-off between how much growth they want in the economy or whether they want the balance of payments to be equal. And then the government could introduce deflationary or tight fiscal policy. This involves shrinking the economy and decreasing AD. Therefore, the government will cut spending and or increase taxes. Higher taxes will reduce consumer spending. The tight fiscal policy will tend to cause an improvement in the government budget deficit. And then they'll also have to trade off between here whether they want the economy to continue growing or how much they're going to shrink it.
So now moving on to a bit of history. The UK economy has run a current account deficit every year for many years, usually more than 2% of GDP. Slow export growth to the EU has been a factor behind the continued BOP deficits. However, the possible conflict between growth and balance of payments depends to a degree on the stage of the development that a country has reached.
Okay, now, economic growth. The UK government wants positive and sustainable economic growth around 2%. If it goes above this, normally inflation will follow, so prices will rise, things will get more expensive, and people will have less to spend, consumer spending might go down, and then that would shrink the economy. And if it goes below that, then you could be heading towards a recession.
Now moving on to policies to improve growth and the balance of payments. Supply-side policies, firstly, is a way to do this, e.g. by reforms to improve labour productivity, incentives to boost research and development and innovation.
Or there's an exchange rate depreciation. This is a depreciation of the currency, which in theory makes exports more price competitive and imports are more expensive. But the effects are dependent on the price elasticity of demand. Also, if the government has sound macroeconomic policies, such as monetary policy to help keep inflation low relative to inflation of the major trading companies, or infrastructural investment to increase export competitiveness, will help to balance out the payments.
Thank you for watching a short revision video on the balance of payments vs growth. Goodbye.